All right, so your bank, about 240 plus branches, kind of very closely linked to the footprint of the Atlanta Fed. I want to ask, we heard from Raphael Bostic yesterday. He says he didn't really see a Fed cut coming until maybe not December. When you're talking to your customers and your clients, how do they feel about Fed cuts? Do they need them for their businesses? Are you hearing that from consumers that they're just looking for some relief?
Yeah. Well, look, I think we know that lower interest rates could be constructive to the lending environment. We've looked at it over time, and obviously with lower interest rates, it's going to allow borrowers to be able to take out capital for their growth at a lower cost. So that will drive loan growth. But what I would suggest is, as we do our surveys with our clients, we have a fairly constructive client base here in the Southeast. At the end of the first quarter, we finished our survey with our commercial clients, and about 41% of those clients who responded felt like their business was going to grow over the next 12 months. When you contrast that to only 17% felt like their business would contract. So lower interest rates will help, but I think given the demographics and the population inflow that continues here in the Southeast, we have a client base that's continuing to expand. Now, the current policies have created some uncertainty, and I think that makes folks sit on the sideline a little longer before they take out that extra dollar of capital. They're going to make sure that they understand all the risk of this current policy. And as you've heard from some of the individuals from the Fed, lower interest rates are less likely because of higher inflation and a job market that continues to be fairly robust. So I think the Southeast is continuing to grow at a pace, maybe a more moderate pace, and lower interest rates would help. But we don't have to have lower interest rates for us to continue to see growth.
Something else that seems to be sparking some uncertainty is the downgrade from Moody's. Some people think it's a lagging indicator if you listen to the Treasury Secretary. Other people think it's long overdue because the other rating agencies have done the same thing years before. But it did create quite a reaction when it comes to the bond market. I want to get your reaction in that move in the bond market and also ask you about your Treasury holdings. So the Office of Financial Research, an agency tied to the Treasury, came out with a report a few days ago. After the SVB crisis, regional banks, community banks, small banks, they had about $700 billion in unrealized Treasury losses. Now that's at about $500 billion. Where's your bank at?
Look, we hold treasuries. I mean, we have about 19% of our assets are in securities, and a large percentage of those would be in treasuries. Having said that, we have had fluctuations in rates, and what we do on the treasury side of our balance sheet is we make sure that we understand what rates do to our overall sensitivity and the value of those assets. So we're not in any outsized position. Any rate moves that we see or any changes in underlying treasury rates are not a large impact to the bank. We carry those in other accumulated losses or other accumulated income. And so it's not a big move for us. We anticipate that, and we try to manage our balance sheet to have neutrality to interest rate sensitivity. So even as the previous conversation, if we see Fed rate cuts, we're fairly neutral to the front of the curve. We are asset sensitive to the long end of the curve because of those fixed rate assets like treasuries. But we manage to an interest rate profile that we're not overly sensitive to rate moves like you're seeing in the bond market.
Your deposit business. What's going on there? A lot of people right now are a bit financially stretched. We talked about inflation. We also talked about a lot of people kind of living on credit right now just due to some of the economic times. When you're looking at your deposit business, is there a difference when it comes to demographics, whether it comes to income or age, when it comes to the willingness of people to actually save money?
It's a really great question, because when you look at the economic data, it would suggest that the U.S. personal savings rate is at historically low levels. So I think that's what you're seeing. You're seeing the impact of inflation on the average consumer, where they're able to save less because they're having to consume more of their income through discretionary spending. Here at Synovus, we tend to move towards the higher end of the income scale for our consumer clients. And so for the last 2 quarters, we've actually seen the average balance per account increase, meaning that people are saving a little more. And I think that's more of a function of the uncertainty that we've seen in the marketplace. People are less willing to spend on larger discretionary items. They're saving a little more. The average balance for us is a little over $10,000 per account. And so I think it shows the resiliency of the consumer. Yes, consumer spending is declining. We have not seen an increase in delinquency or any sort of credit risk on our portfolio, but we're seeing the consumer being a little more practical and spending less and holding on to excess cash in case there are more difficult times ahead.